What's going on, guys? Welcome to another episode of Talking Finance with Transforming Your Life. So we will go a little bit into detail about the different type of accounts that you are able to get at different institutions. Most people know about your standard savings account and checking account. Um, there aren't a ton of accounts that are out there that aren't investment related. So you can typically fall into maybe two, three different categories, sometimes four, but the um, the ones that we'll talk about are pretty simple. So when you enter into any institution, credit unions included, you typically can request for the standard, and then some of the other accounts include like systematic savings accounts, which are like Christmas club accounts or even vacation club accounts, something similar to that. And those typically have somewhat of a slightly higher interest rates, not a ton, but they will have a higher rate for the specific purpose of saving. And then you will typically run upon other accounts that you know are called CDs, or certificate of deposits. With certificate of deposits, they are meant to be much higher accruing interest deposit accounts, but those accounts are limited in terms of the withdrawal ability. So because they give you a larger amount of interest that you can accrue throughout a certain time frame, so you can choose up from 3 months to 6 months to a year, 2 years, 3 years. Generally up to about five is kind of the average, but depending on what product and service that is given to you at that time, it will give you kind of the availability. So certificate deposits will typically have a penalty for withdrawing early. And the entire point is, if the institution is going to be giving you more interest and more money back, then they want to be able to effectively use the funds, right? So it's not actually using the funds, but because it's sitting there, it's still there. No one is actually physically touching it, but it has the ability there. But in order for for them to encourage you not to use your own funds, that's why the penalties are there, and those penalties will change depending on what term you've chosen, and it will typically uh, be a percentage as well in the inclusion of that penalty. So and then the other account that you typically will find at those institutions are what you call money markets too. So money markets are a funny thing, because unless you are talking to a financial advisor, um, you the money market itself does not actually go into the market. The interest rates for all deposit accounts are affected by um, the prime rates anyways. So the money markets are what I would almost consider like a glorified checking account, which give you somewhat more access and a slightly higher interest rate. So if you're considering kind of a tier of which interest rates are higher, you'll have your savings account and your checking account down here, your money markets typically right here, and then your CDs will be typically higher. And then there are other investment type of accounts that will typically give you higher interest rates over the long term of things. So hopefully this helps you guys. Have a good day.